Look, Apple's stock price isn't the highest in the market, not even close, but it's absolutely one of the most valuable companies on Earth, with a total value hovering well over $3 trillion. So how do professional investors actually measure the true size of a company if they aren't just looking at the price of a single share? Well, the answer is market capitalization. And once you grasp this one fundamental concept, I promise you, you're never going to look at stocks the exact same way again. Welcome to The Explainer. Let's dive right in. Here's our roadmap for today's explainer. We're going to cover the stock price myth, exactly what market cap is, the different size categories, why market cap actually matters, and finally, how to use it for building your portfolio. All right, section 1, the stock price myth. This right here is arguably the single most common mistake made by new investors. We're all conditioned to look at the price tag of an item to understand its value. So let me ask you a direct question. Does a higher stock price automatically mean a bigger, more successful company? Like if you see one company trading at $500 a share and another at $20, is the $500 stock the heavyweight champion? Most beginners assume yes, but that is fundamentally false. And here's exactly why. Imagine two companies. Let's just call them Company A and Company B. Both have their stock currently trading at exactly $50 per share. Now, if you only look at the price tag, they look identical, right? But Company A only has 5 million shares available in the open market, while Company B has 5 billion. When you do the math, Company A is worth $250 million, but Company B, it's worth $250 billion. So Company B is massively larger, despite having the exact same share price. It just goes to show, share price alone is a completely deceptive metric. Moving on to section 2, what exactly is market cap? So if share price is an illusion, we need to reveal the core truth that Wall Street actually relies on. And that is market capitalization, or as it's usually called, just market cap. Put simply, it's the total dollar value of all a company's outstanding shares of stock. To put it in a really simple analogy, imagine you didn't just want to buy one single share of a company, but you wanted to buy the entire company outright, taking every single share off the market. The amount of money you'd need to write that massive check, that's the market cap. It is literally the market's real-time estimate of the company's overall size. And the math behind this is beautifully simple. It's a foundational formula. Market cap equals the current share price multiplied by the total shares outstanding. Now remember, because the stock market is open and actively trading every weekday, share prices are constantly rising and falling. And because of that, a company's market cap is also changing continuously, in real time, based on everyday supply and demand. Let's walk through a dead simple mathematical example together, just to really lock this in. So if you find a company trading at $50 a share, and you look up its financials and see it has exactly 1 million shares outstanding, you just multiply 50 by 1 million. Boom. The market capitalization is $50 million. You now know the true size of the business you're looking at. So the absolutely crucial point here is this. The stock price, that's just the cost of one single slice of pizza. The market cap is the size of the whole pizza pie. A company could cut a small pie into 1 million tiny slices, making each slice incredibly cheap. But another company could have a massive pie cut into just 4 giant slices, making each slice very expensive. Beginners fall into this trap all the time, buying stocks just because the price looks cheap, say $2 a share. But a $2 slice of a microscopic pie is definitely not a bargain. Always, always look at the whole pie. All right, section 3. The size categories. Now let's actually map out the landscape. At the very top, we've got mega cap companies valued at over $200 billion. We're talking absolute industry-dominating giants like Apple or Amazon. Next is large cap, ranging from $10 billion to $200 billion, featuring household names like Target or Ford. Right in the middle, mid cap sits between $2 billion and $10 billion. These are often growing tech or retail brands. Then we have small cap from $250 million to $2 billion. And finally, microcaps below $250 million, which tend to be highly speculative penny stocks. To really visualize this, think of mega and large cap companies as giant cargo ships. They are massive, they're stable, and they're highly dependable. But because they're so huge, it takes a ton of time and energy to change direction or, double their speed. Small and microcaps, on the other hand, well, they're like speedboats. They accelerate incredibly quickly and maneuver with this crazy agility, giving you explosive growth potential. But they're volatile. They feel every single wave and can easily capsize in a bad storm. Think about it this way. Investing in mega and large caps is kind of like looking at a deeply rooted oak tree. The risk is lower, the earnings are steady, but that initial explosive growth phase, yeah, that's largely past. Small and micro caps, though, they have the highest risk and the highest volatility. Buying a small cap is literally like planting a risky seed. It might grow into something massive or it might not sprout at all. And a really common beginner mistake is ignoring these risk categories altogether and just blindly chasing hype in the microcap space without understanding the fundamentals or the incredibly high risk of, capsizing your portfolio. Which brings us to section 4, why market cap actually matters. So, how do smart professional investors actually use this metric on a daily basis? Well, first, it allows you to compare companies fairly. You can finally see who the real heavyweight is in an industry, regardless of some arbitrary share price. Second, it instantly tells you the baseline investment risk and the expected growth potential. Like a $500 billion company simply cannot double in size as easily as a $500 million company can. That's just a fact. And finally, it explains how the market works as a whole. Major indexes, like the S&P 500, are market cap weighted. That means massive mega-cap companies make up a larger percentage of the index, and when those giants move, they literally pull the entire stock market with them. Let's wrap things up with Section 5, building your portfolio. Okay, so how do we apply all of this into an actionable strategy? Look, a huge mistake is putting all your eggs in one basket. If you only buy large caps, sure, your portfolio might be safe, but it's probably going to lack the raw energy needed for high returns. On the flip side, if you only buy small caps, you might lose your shirt in an economic downturn. A theoretical balanced portfolio might put, say, 55% in large cap for a really steady, reliable foundation, 25% mid cap for some moderate growth, and 20% in small cap to capture that explosive upside. You're basically mixing the seasoned veterans with the high-energy rookies. But of course, there's no one-size-fits-all answer here. Your ideal market cap allocation completely depends on you. If you're a beginner or maybe a retiree looking for income and safety, you might lean heavily, maybe 80% or more, into large cap stocks. But if you're in your 20s or 30s, you've got a long investment timeline ahead of you, and you have a high tolerance for risk, you might allocate a much larger percentage to small and mid caps to let that compounding growth really work its magic over the decades. As we finish up this explainer, I want to leave you with this one core takeaway. Seriously, burn this quote into your brain. A stock's price tells you what one share costs. Market capitalization tells you how big the entire company really is. By looking beyond the sticker price and calculating the true size of the pie, you're going to instantly elevate yourself above the average beginner and start evaluating businesses exactly the way the professionals do. So, I've got a question for you. Before diving into this explainer, did you think a higher stock price automatically meant a bigger company? I really want to hear from you. Tell me what surprised you the most down in the comments. And hey, if this breakdown helped shatter some misconceptions and finally made the stock market click for you, please hit that like button, subscribe for more focused, visually driven learning, and maybe share this with a friend who's just starting their investing journey. Thanks so much for joining this explainer, and keep on learning.